If you own a business, it's essential that you understand insurance to protect your company and its assets. Almost all coverage you will need to cover your business falls within the scope of either property insurance or liability insurance. But do you understand the differences between the two? Property and liability insurance are two types of insurance that protect against different types of risks. In today's video, we're going to go over the differences, talk about policies that fall under each segment, either property or liability, and also give you some claim examples that we've seen at our agency to help you understand how these policies can protect you. Before we get started, let's state some of the obvious. Lots of people don't know what it means to have property insurance and what it means to have liability insurance, and really don't understand the difference. Property insurance protects against loss or damage to tangible property, such as a building or contents of a building. It typically covers damage caused by fire, theft, and natural disasters. On the other hand, liability insurance protects against financial loss from legal claims made against the policyholder. Liability insurance typically covers costs associated with legal defense and any damages or settlements that may be awarded due to a lawsuit. Now, common types of liability insurance include general liability, which covers a wide range of risks, and professional liability insurance designed for specific professions such as doctors, lawyers, and accountants. We will get into further discussion regarding other types of liability insurance later in this video. So let's dive deeper into each type and review some common property and liability policies for business owners. Throughout the video, I may use the terms first-party insurance and third-party coverage. First-party insurance refers to the insurance applying to the insured's own property or person. Third-party liability coverage generally refers to insurance covering one party's legal liability to another party. Let's start by reviewing liability insurance examples and how each of these types of policies can best protect your business. The first one, and the one that we hear about all the time, is fairly mainstream, is commercial general liability, otherwise known as CGL. And commercial general liability, or CGL, is the backbone of most businesses' liability protection. It's a standard policy to protect business organizations against liability claims for bodily injury or property damage arising from premises, operations, products, and completed operations. Recently, we filed a general liability claim for one of our clients who's a painting contractor. Our painting contractor's crew was out on a job painting somebody's house, and one of the employees mistakenly left a dirty rag, oily paint rag, in the client's garage, in the homeowner's garage overnight. The rag combusted spontaneously, unfortunately caused a fire, and caused $500,000 in damages. So our policy responded, paid directly for the repairs to the homeowner, and made sure their home was rebuilt properly, the whole 9 yards. The next type, let's talk about product liability insurance. Now, product liability insurance can protect a business against financial loss incurred because of damage or injury resulting from the use of a covered product. Now, also, product liability protects contractors from the liability incurred after a job is complete, also known as completed operations coverage. One of the most prolific claims I've ever witnessed in my career involved a product liability loss for a water bottling company. The company allowed its product, which was the water, to allegedly become contaminated, causing bodily harm to several people. Some people even suffered liver failure. The lawsuits were in the millions. The liability company responded by providing defense, legal counsel, and payouts for bodily injury and continuing issues. Next, let's talk about professional liability insurance. Professional liability is designed to protect traditional professions. Think about the white-collar type professions: accountants, attorneys, real estate agents, insurance agents, engineers. The coverage provides protection against liability incurred as a result of errors or omissions. That's why you may hear of professional liability referred to as E&O, errors and omissions, in performing their professional service. Now, there are a few exceptions, but most professional liability policies only cover financial or economic losses that third parties suffer due to the error and omission. Some professional liability policies written for physicians, architects, and engineers will cover bodily injury and property damage claims, otherwise known as contingent bodily injury or property damage, because the error or omission may lead to a third-party bodily injury or property damage loss. But most commonly, a general liability policy is needed to cover BI and PD liability claims. So compared to CGL, which are normally written on what's called an occurrence form policy. Don't want to go too deep into policy triggers, but if you look on my YouTube channel, you will find information about occurrence form policy. Most professional liability policies are written on what's called a claims made trigger or a claims made form. I speak a lot about claims made policies, how those triggers work, and some important information that you need to keep in mind if you have a claims made or you're looking to purchase a claims made policy. It's also important to note that most professional liability policies contain what's called shrinking limits. And what that means is that defense costs reduce available policy limits. defense. This differs from a CGL policy, where most times defense costs are in addition to the policy limits, so they don't reduce the limits of coverage for all the cost to defend the policyholder or defend the lawsuit or the claim. We recently filed a claim for our clients in the financial advisory business. Financial advisors, they carry professional liability or errors and omissions. With investment losses mounting in 2022 and even into the second half of 2021, our client was sued for failure to trade out of investment when requested by their client. So the client requested that they trade out of a more risky investment into something more conservative. The advisor at our client's firm failed to do so. The oversight led to losses for the investor, and a professional liability claim was made because our client was sued. That's an example of how professional liability from an error or omission to a third party suffered economic loss, financial loss, claim came against the liability policy. Last but not least, under the scope of liability insurance, let's talk about management liability insurance. Management liability insurance has become a hot topic over the last few years because it covers exposures faced by directors, officers, managers, and business entities that arise from governance, finance, benefits, and management activities. Policies under management liability lines include directors and officers liability, otherwise known as D&O, employment liability insurance, or EPLI, fiduciary liability, and crime insurance. Crime insurance includes coverage for kidnap, ransom, and extortion. So recently we helped a client, and we see a lot of EPLI claims now. I got to tell you guys that. Look back on my YouTube channel, search EPLI. I recently recorded a video about the changing market for employment practices liability insurance, becoming very difficult, lots of losses, lots of claims, causing carriers to change their strategy, writing the coverage. We recently filed a claim under a client's EPLI policy because an ex-employee sued them for wrongful termination and failure to pay correctly. Unfortunately, these types of lawsuits are becoming more burdensome for our clients across all industries, and employment practice carriers or carriers that issue EPLI policies are starting to change the way that they're doing business or change the way their policies are written. Now let's address some common types of property insurance purchased by business owners. Remember, before we get any further, property insurance is first-party insurance. It's coverage for the insured's own property or person. The first one that's common under lots of commercial property policies is the building and contents coverage. Building coverage is pretty self-explanatory. It covers the building that an insured may own, commercial buildings, industrial buildings, office type buildings, any type of building that is used for commercial use, and the contents within the building, otherwise known as business personal property or BPP. People purchase building and contents coverage to insure against direct damages to this property. We've witnessed several claims for buildings and contents, as you can imagine. We're in California, widespread wildfires of 2018. We have lots of clients in the area where those wildfires happened up in Northern California. Hundreds of claims for building damage and contents damage or business personal property damage. The next type of coverage I want to talk about under a commercial property policy is business income coverage. Very important, widely misunderstood, something that we supply our clients with when we write a business owner policy or a commercial package policy. And it's important coverage because it covers the loss of income sustained by a business due to damage to its premise by a covered cause of loss. Again, has to be a covered cause of loss. The coverage has to trigger because the loss is covered first. Business income, going back to the COVID days again. Lots of businesses were forced to shut down, couldn't operate. Business income did not kick in because the virus was not a covered cause of loss. But when it does cover, such as a fire, we always use that because that's the easy one to remember. It can provide coverage when a covered cause of loss results in a suspension or even a slowdown of operations. It's essential to know that coverage applies to loss suffered during the time required to repair or replace the damaged property. It may also be extended for a specific number of days after the completion of the repairs, but there are waiting periods sometimes. We sometimes refer to these as time deductibles. The waiting period can be 24 to 72 hours after the damage occurs. That's when the coverage will start to kick in. Some carriers allow us to reduce that to zero. We try to do that whenever we can. It's important that you know what your waiting period is when it comes to business income coverage. And by the way, you may hear of this coverage referred to as business interruption coverage, also known as business income coverage. The California wildfires, going back to 2018, caused widespread disruption and damage to property. In many cases, our clients relied on their business income coverage to replace lost income while they were shut down. Also, very important to note, there's civil authority coverage that triggers within the business income, and many of our clients received business income replacement because of civil authority, even though they didn't sustain direct damage as a result of the fires. fires. Their business was in evacuation zones, so they couldn't operate the business, and the civil authority coverage inside the business income form kicked in after a 72-hour waiting period and was able to help many of our clients replace some of their lost income and pay for some of their ongoing fixed expenses. Next, improvements and betterments. I talk to our clients all the time about improvements and betterments. Many businesses lease space. They don't own their own building, so they lease from a landlord, but that doesn't mean that they don't pay for additions or changes to the space. They want to improve the space. They want to make it their own. So they're going to pay for those permanent additions or changes to the area that cannot be removed. And since they can't be removed, they've now become a permanent part of the space. The client needs tenant betterments and improvement coverage to protect that investment should there be a loss to the space. Now, some insurance carriers assign improvement and betterments values to the building coverage. Others assign it to the contents coverage, and in some cases carriers may list it as a separate coverage, but you need to know the differences or make sure the values are assigned correctly. It's super important, so check for that. Talk to your insurance representative to make sure tenant improvement and betterment coverage is assigned and the values are there if you desire to have that coverage. Next, difference in conditions insurance, also known as DIC. DIC is purchased in addition to a commercial property policy to cover perils that are not insured on the regular commercial property policy. Two most common hazards that we hear about all the time that are excluded under the regular commercial property form: earthquakes and floods. This is where a DIC policy would come in, cover for the earthquake peril, cover for the flood peril, make sure the client's protected on their commercial property if an earthquake or flood were to occur. What can FOA do for you? So we have the knowledge, we have the offerings as an independent insurance agency to partner with you and help you protect your business. We believe heavily in education. We believe in letting our clients understand what they're purchasing, what they have protection for, what they don't have protection for, and to make the best decision for their company so that they can protect themselves, protect their assets, protect their livelihood. We're happy to help. You can call us here at the office. Our direct dial is 858-384-1506. Remember to subscribe to our YouTube channel, hit the little notification bell so that you're made aware of every video that we release. Every single Tuesday we release a new video. Hit that little like button, comment below. We're happy to hear from you, and we thank you for your support and thank you for watching another video. We'll see you on the next one. Take care.